All right, let's get right into it. Today, we're going to tear down the facade of the stock market. We're going to expose the raw mechanics working underneath, the actual system that governs global capital. Let's begin.
You've heard it a million times, right? In Vegas, in life, the house always wins. It's the foundational law of the financial markets, too. But what if I told you that you could actually learn how to be the house?
The second you find yourself glued to those flashing red and green numbers on a chart, it's over. The game is already lost. You're playing a game that was designed by institutions, and it has one purpose: to harvest capital from the impatient.
So I need you to forget everything you think you know. That idea that the market is just a simple place to buy and sell parts of companies, that's the story they tell everyone. It's a nursery rhyme. Today, we're looking at the institutional reality. Okay, this right here, this is the key to everything. The stock market isn't really about stocks. It's a machine built for one single purpose: to execute time arbitrage. It is designed to systematically transfer wealth from people with a short time horizon to those with an infinite one. I mean, just look at the contrast here. It's all about scale and speed. On one side, you have the retail trader totally surrounded by frantic charts reacting to every little news blip. On the other side, the institutional investor. Think of it like a massive aircraft carrier. It moves so slowly you can barely see it, and it operates on timelines that span generations. One provides all the chaotic energy, the other is the destination for all that capital.
This is like the secret handshake of the big money world. They understand that all the daily chaos, the volatility, that's just the price of admission. It's the fee you have to pay to play. For the retail trader, though, that same chaos creates a desperate need for liquidity, that ability to sell right now, which the institution is more than happy to provide. Or not.
So to really understand the architecture of this whole thing, we have to start at the very foundation. Let's look at the two very different markets that almost everyone mistakenly bundles together as one.
First, you have the primary market. This is where real value is actually born. A company issues stock, they raise real capital, they build real things. That's the creation of an asset. But as soon as that's done, those shares get tossed into the secondary market. And that's when it basically becomes a giant casino, where these titles of ownership are just chips passed back and forth at blinding speed.
So this is the crucial question you have to ask yourself. What is your role here? Are you the grease that keeps the casino's gears turning? The one providing the liquidity for all the high-frequency algorithms? Or are you the quiet owner of the entire machine, just collecting a toll from all the activity inside?
And that leads us right into phase 2. Now that we get the structure, let's talk about the physics of the machine itself. What actually makes an asset go up in value over time?
It's the most basic question you could ask, and the answer is what separates the amateur from the architect. It's got nothing to do with hype or news or what some talking head on TV is yelling about. The retail world, they live on stories. They'll say, oh, the stock went up because the news was good. But the institutional world, they couldn't care less about the story. They operate on one single brutal formula: return on invested capital. You know, in plain English, it just means, can the business take $1 of capital and reliably turn it into more than $1? That's it. That's the whole game. And here's the thing. If a company is a true machine for generating cash, its stock price has no choice but to follow that value creation over the long term. It isn't magic, and it's definitely not luck. It is a fundamental law of financial physics. It's like gravity. Just look at any major crash in history. 1929, the dot-com bust, 2008, 2020. You see the same pattern every time. You see the jagged line of the price just collapsing in pure fear and panic. But underneath it, there's this steady golden line of intrinsic value, the actual cash-generating power of the businesses. It holds steady, and every single time it acts like a center of gravity, pulling that price right back up. And this, right here, is where the great transfer of wealth happens. When the market panics and prices fall, the amateur, the dummy,
sees red on their screen, and sells at a loss. They run from the sale. The architect, though, they see the exact same event as a massive opportunity. The cash flow of the business hasn't changed, but the price to buy it just went on sale. The yield just went up. They don't run from the sale, they try to buy the entire store.
This brings us to the final and by far the most powerful phase, the engine that drives this entire thing. This is the force that turns simple patience into almost unimaginable wealth.
Right, we've all heard this quote, it's famous for a reason. But in the context of the market's architecture that we're talking about, it takes on a much more aggressive, much more powerful meaning. I want you to think about that word for a second. Violence. This is not a gentle, passive process. It is the violent expansion of your capital over decades. It's an unstoppable force that just annexes more and more of the world's economic output for you, its owner. Here's how to picture it. A 10% return doesn't just make you 10% richer. It means your pool of capital has physically expanded its surface area. It's gotten bigger. So now it's better able to catch the next downpour of dividends, earnings, and returns, which in turn expands it even more. You see how this chain reaction creates that violent expansion? And this is the critical mental shift. A consumer spends money to get goods. A capitalist, on the other hand, uses money to buy systems. A stock isn't a thing you buy. It's a legal claim on the output of an entire system, a system made of labor, intellectual property, infrastructure, and a brand, all working for you. So after deconstructing the architecture, understanding the physics of value, and appreciating the engine of compounding, well, it's time to graduate. Let's consolidate all of this into 3 simple, powerful rules. Rule 1 is a change in your identity. You're an owner, not a gambler. Rule 2 is a change in your focus. Ignore the chaotic noise of daily prices and listen for the clear signal of a company's actual earnings. And Rule 3, this is the ultimate weapon. Your edge isn't a faster computer or some secret algorithm. It is the simple, profound ability to wait. And that is the ultimate summary of everything we've talked about. The entire complex trillion-dollar machine is designed for one purpose: to take money from those who are constantly moving, trading, and reacting, and give it to those who sit still, patiently owning the machine itself. So, I'll leave you with this one final thought. Your goal isn't to be the frantic river of liquidity that feeds the system. Your goal is to become the calm, deep, and ever-expanding reservoir that the river flows into.